Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Power Assets Holdings Limited annual report. Power Assets Holdings Limited offers a diverse range of businesses and services. At the core of its operations are electricity generation, transmission, and distribution activities in various countries including Hong Kong, the UK, Australia, and internationally. The company generates energy from multiple sources such as thermal, renewable energy, and waste. In addition to electricity-related services, Power Assets Holdings Limited also engages in the transmission and distribution of oil and gas. This indicates its involvement in the broader energy sector, beyond just electricity. Furthermore, the company provides trust administration and management services, which suggests a presence in the financial services industry. Overall, Power Assets Holdings Limited's business portfolio encompasses various sectors including energy generation, transmission, and distribution, as well as financial services through trust administration and management. Power Assets Holdings Limited market capitalization of $133 billion is significantly larger than the average industry peer of roughly $12 billion. This shows that Power Assets Holdings Limited holds a significant advantage in their industry. Power Assets Holdings Limited trades at a higher price-to-earnings ratio of 22 times and a higher price-to-book ratio of 1.49 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 7% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 4.53%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for a company are multifaceted. A strong asset base, which generates steady revenue streams, is a key contributor to growth. The company's diverse mix of infrastructure businesses also plays a significant role, as does its core focus on investing in regulated businesses. Additionally, new connection fees from Australian gas networks and multi-net gas networks have contributed to revenue growth. The company has also secured long-term power purchase agreements, such as the 25-year agreement with Canadian Power's Meridian plant, which provides consistent cash flow. Furthermore, organic growth across its portfolio, investing in mature businesses in well-regulated energy markets, and pursuing new markets in renewables and sustainable energy have all contributed to revenue growth. On the other hand, there are several drivers of revenue decline. Softer earnings due to revenue recovery in 2024 from UKPN have negatively impacted revenue. Lower market prices and production from Energy Developments Thai Limited have also led to a decline in revenue. Furthermore, a decline in interest income by $141 million has contributed to the decrease in revenue. The net income of the company experienced a significant decline between 2024 and 2025, decreasing by $234 million, or 20.7%. This substantial drop in net income is a cause for concern, indicating that the company may be facing financial difficulties. On the other hand, profit margins saw an improvement during the same period, increasing by 5.2%. This increase suggests that despite the decline in net income, the company was able to maintain its pricing power and efficiency, allowing it to retain more revenue as profit. The contrasting trends between net income and profit margins highlight the complexities of a company's financial performance and the need for careful analysis to understand the underlying factors driving these changes. The company's financial performance indicates a strong ability to generate cash from its core business activities. A key indicator of this is the positive operating cash flow, which has been consistently demonstrated over time. Specifically, page 6 highlights that the company was able to fund its capital expenditures and investments using cash generated from operations, demonstrating a self-sustaining financial model. Furthermore, the data presented on page 10 shows a significant positive operating cash flow of $1,231 million in 2025. This substantial figure underscores the company's ability to generate substantial cash from its core business activities, providing a solid foundation for future growth and investment. Overall, these indicators suggest that the company is generating positive operating cash flow, which is a crucial aspect of its financial health. The company has experienced a notable shift in its debt levels over time. Initially, it may seem that the total unsecured bank loans outstanding have increased by 33%, which is a significant jump of $114 million. However, this increase should be viewed in context with the overall decrease in debt level. The data reveals that the company's debt has actually decreased from $505 million to $319 million. This indicates a reduction in the company's financial obligations, suggesting a more stable financial position. The performance of various segments within the company has been analyzed, revealing both strong and weak areas. The United Kingdom and Australia segments stood out as top performers, generating significant revenue and profits. In contrast, other activities across the board experienced losses, with a total loss of $451 million in reportable segment profit. Additionally, the HKEI segment struggled, with negative earnings and operating profit/loss. These results indicate that while some regions are thriving, others require improvement to achieve overall success. Management's outlook for the company is centered around sustainability and growth. The company plans to focus on sustainable energy through investments in renewable energy sources, which will drive future growth. A significant contributor to this growth will be the UK market, where the company has a strong presence. In terms of specific projects, management has outlined several key initiatives. These include the commissioning of a new gas-fired combined-cycle unit in 2029 and the launch of 3 oil-fired units starting from 2027. Additionally, the company is making progress in securing sustainable electricity and green gas supplies through its operating companies' work on hydrogen and biomethane. Management has also identified divestment as a key strategy, with plans to sell its 100% interest in UKPN to Enjai SA by the end of June 2026, subject to certain conditions. Furthermore, investment in strategic infrastructure is seen as a key growth driver, aimed at enhancing network capacity and supporting future expansion. Overall, management's vision for the company emphasizes sustainability, growth, and strategic investments that will drive long-term success. The company has made strategic decisions to expand its business through acquisitions and divestitures. In terms of acquisitions, the company is focusing on mature businesses in well-regulated energy markets, as well as new markets in renewables and sustainable energy. This move aims to diversify the company's portfolio and tap into emerging trends. On the other hand, the company has also made deliberate decisions to divest certain business units that no longer align with its strategic goals. One notable example is the divestiture of UK Rails, which was completed in January 2026. This decision allows the company to concentrate on more core areas and allocate resources more efficiently. The company's financial performance is reflected in its dividend payments. According to the provided information, the company has indeed paid dividends. This indicates a commitment to returning value to shareholders through regular distributions. Further details regarding the specific amounts of final and interim dividends can be found on page 1 of the document. Additionally, page 17 provides insight into the company's dividend income for the years 2024 and 2025, with notable figures of $56 million in 2024 and $49 million in 2025. That concludes the financial summary for Power Assets Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.